Today, I want to talk about the tax implications of losing a spouse. It's a horrible thought, but a lot of times people will lose their spouse and be in financial turmoil. And one of the things that they deal with is taxes. And I'm going to talk about some of the things that a widow or a widower should really think about, maybe even in advance of losing a spouse when it comes to taxes. I'm going to bring in my co host, Tony Shore. Tony, welcome to the show. We're going to be talking about taxes. So, what I want to do, as I always like to do when we talk about taxes, is have
Cry.
my kids come in and give us a little pep talk. You ready for this?
Dolphin Financial Group does not provide tax advice. See a CPA for tax advice.
There he goes. That was Johnny. So, taxes. Taxes after losing a spouse. So it's like, hey, you just lost a spouse. Bam. Let's talk taxes.
Wow. Yeah. I mean, Dan, could you pick a couple of happier topics? Taxes and losing your spouse?
Well, death and taxes, right? What else can't we avoid?
Right.
Yeah. So I think, yeah, it's a tough topic. We've done this show before, but years ago, before the internets, before the video. um, but it's important to know that when you lose a spouse, your tax liabilities, your tax situation is going to change pretty drastically. And so if you don't know about it and you lose a spouse and you're like caught unaware, now you're talking even more turmoil, more trauma. So let's talk about this for the people out there that are married and may not realize some of the big issues. One of the big ones people always ask me about is, oh, what happens if my spouse dies to their IRA? I get that, but I have to pay taxes on all that. I think a lot of people realize that if you inherit an IRA as a spouse, there are no tax implications. You make it your own. Not the same if you inherit an IRA from someone else, not your spouse. We'll put the show up here for those that are interested in that. But one of the big issues about losing a spouse, obviously, you're going to be going through turmoil. You're going to be going through trauma. I would recommend that you don't make any major financial decisions when you lose a spouse. Give it some time. Don't rush, right? But when it comes to taxes, IRS is not going to wait.
Yeah. But Dan, I have a quick question here. You say, and it's right there on the screen, inheriting an IRA, there's no tax implications for the spouse. But if it's a traditional IRA, what do you mean by no tax implications? Because if my wife passes and she has an IRA, which she does, I inherit the IRA, but I still have to pay taxes on that money if I take it out, right? I just don't have to
Take
pay
it out.
inheritance tax. Is that what you're talking
Well,
about?
no, so different. So if you inherit an IRA from your spouse that passed, it becomes your own. You can make it your own. So it stays the same in terms of tax deferral. You're going to have to pay tax on it at that some point,
Sure.
but you don't have to take it right then and there.
Right.
Whereas if your mom died and left you in an IRA, that's a different story. Now there's tax implications. Now you have a timeline that you have to deal with it and so forth. So, but for a spouse, losing a spouse, assets pass, generally speaking,
Right.
to each other without any tax implications.
Okay.
Now, what also changes is your tax filing status. And you see these when you file your taxes, if you file your taxes. I'm hoping you file your taxes if you're watching. Um, you could file jointly, married. You could file married filing separately. You could file qualifying widow, single, head of household, so forth. And so when you're married filing jointly and you lose a spouse, all of a sudden the question becomes, can you still file married filing jointly? So I'm going to put a link down here for people watching on YouTube. There's an IRS tool that's actually pretty good. Surprise, surprise. The IRS tries to make it easy to figure out what is your filing status? What is your
Yeah.
filing status? And you go through it and you answer questions. And it'll ask you, hey, are you married? Yes, but my spouse died. Well, did they die this year or did they die previous year? Well, they died this year. Okay. And they go through different things and it gives you what your filing status options are. But here's the key to note for those of you that lose a spouse. If you were married in the year you lost the spouse, you could file as married, filing jointly or separately, depending on what your situation entails. You could file married for that full year if you lost the spouse that year. So if I literally had a client whose spouse died January 1st, just random, right? What are the odds? She was able to file that full year as married because she was married for a day that year.
Interesting.
And it's important to know that.
Yeah, I did not know that. That's a new one.
So yeah, stick with me, Tony. I teach you some things.
I
Now,
know. That's why I'm here each week.
I want to give an example to kind of show how important this is. So there's some other taxes that you have to figure out, not just income tax, but there's Social Security tax. This is a show about retirement planning. So odds are the viewers are close to or already taking Social Security. And Social Security is taxable. We've done shows on Social Security taxation. It is taxable. Not all of it, though. So there's some limits that were made in the 80s that haven't been updated for inflation. It's another story. But the limit is $25,000 a year for a single person or $32,000 for a joint person filing jointly. That's provisional income. Real quick, provisional income is half of your Social Security benefit plus all your other income. So if you go from a married person to a single person, the amount of Social Security income that is taxable will change based on these numbers. Also, what changes? Tax brackets. We know tax brackets. These are the ones that go 0 to 10, 10 to 12, 12 to 22, based on income. They are roughly half for a single person than they are for joint. So you can make double the amount of income and stay at that tax bracket as a joint person. But if you lose your spouse, now you're at the single bracket, except that first year, right? Remember,
Yep.
right? So that's why it's important. So also changes, the standard deduction gets cut in half. So 29,200 in 2024 for a married couple. Under age 65, you get a little bump. Did you know that, Tony? You get a little bump up when you turn 65 in your standard deduction.
No.
Yeah, you get an increase in your standard deduction. But generally speaking, it's half. So 29,000, you lose a spouse. Now all of a sudden you can only deduct 14,600 as deduction. So let's use an example to kind of talk through some of the implications here. A couple has $50,000 of income. We'll say 40,000 of the income comes from Social Security. And we'll say they're both getting about $20,000 a year from Social Security. So that's not unreasonable. What is that? $1,800 a month, something like that. So they still are short. So they use 10,000 for their IRAs. So let's just imagine this couple, and this is very simplistic, but 40,000 from Social Security, 10,000 from IRA withdrawals. Their provisional income in this scenario is half their Social Security, which is 20,000, and all the other income, which is 10. So their provisional income is 30,000. If we go back to this, jointly 32,000, they don't pay any tax on Social Security. None of their Social Security is taxable in this case. So they're getting $40,000 of Social Security income tax free, which is nice.
Yeah.
They pay tax on the 10,000. They pay tax on the 10,000 withdrawal from the IRA. However, the standard deduction is 29,000. So odds are they're paying zero tax in this scenario as a married couple. But that sounds great. Married jointly, no taxes. Single, all of a sudden they have taxes. So let's fast forward. Spouse dies, they still have 50,000 of income. But now let's look at really what happens. This is really important for people to understand how just doing nothing different, really, just losing a spouse dramatically changes their income. They're going to now, so let's say the husband dies and the wife is a widow and she now has to file single. Okay. She needs 50,000 of income. Would you say, Tony, that $50,000 of income, you lose your spouse, your income need's not going to drop dramatically?
Your
Or would you think
income needs are not going to drop, but your
not
income
too
will.
much?
But your income
Your
will.
your income will. Well, maybe. So in this case, we're saying she still needs $50,000.
Right.
So instead of getting $50,000 from 40,000 Social Security, which she can't, so she loses one of the Social Security benefits, whichever's lower. We'll just call it half. So she now only gets 20,000 from Social Security. She still needs 50,000 to live, so she's going to pull 30,000 from the IRA. Okay, so 20,000 from Social Security, 30,000 from the IRA. We still got 50,000. She's okay. Goes from paying no taxes. Now, all of a sudden, what's going to happen? Let's look at the provisional income. Provisional income, again, half the Social Security benefit, so 10,000 plus the 30 from Social Security. I mean, from the IRA. That's $40,000 provisional income. We look at the provisional income chart. She's well above the $25,000 of provisional income. That's taxed, not taxed. So her Social Security is now taxable. They've gone from non-taxable Social Security as a joint couple to taxable Social Security as a single person. Additionally, the 30,000 from the IRA is taxable and the standard deduction gets cut in half. So now that's taxable. So she's gone from no taxes on 50,000 to taxes on 50,000, and really nothing has changed besides losing a spouse. So not only do you get the whammy of losing a spouse, loved one, and all the drama associated with that, you now get the IRS saying, but bam, we're going to tax you on that same level of income because
Terrible.
You are now filing single.
They need to change that law. It's really penalizing people who lose a spouse, widows and widowers. That's not good.
Right. Now, that first year, she can still file jointly. And that's the time to make some financial moves to show some income because you still are showing income for two, even though it's only income for one. So you make some moves, but you can make some moves prior to, which I'll get to in a moment. But you're right. There's a penalty to it's not tax. And I think one of the main reasons is because they didn't tie the Social Security taxation rate or the income level to inflation. They left it at 25,000 and 32,000 from 1981, which back then 25,000 for a single person was not bad. You can almost say to yourself, okay, if I had 25,000 of Social Security, I could be okay. 25,000 in 2024 is nothing.
It's nothing.
It's nothing.
Yeah.
So they could fix it by easily just adjusting the Social Security taxation limits on Social Security by inflation. Problem solved.
Right now, Dan Wendell for president is all that I'm thinking. It's all that's going through my mind.
Right.
Dan Wendell for president. You need to change that.
That would be the first thing I do. So let's remember inflation. Remember how we all complained about it? And we were all saying, oh, inflation and blah, blah, blah. How about we adjust inflation for Social Security people, retirees, because they're not going back to work. They're not going to go ask for a raise. Yeah, I get upset about this. Okay, so that's in a nutshell how people can get in trouble with taxation just by losing a spouse.
Wow.
Really from no fault of their own, besides maybe not preparing.
So you said there are ways to prepare ahead of time for this.
Yes. I want to find. I had another here. Here we go. Capital gains implications as well. Before we get into things you could do, here's another issue that they'll face: capital gains tax. Now, when you invest in something and it grows, say you bought $100,000 worth of stock and it turned to $120,000 because you're a genius, you pay taxes on the gain at a different rate than ordinary income tax. You pay capital gains tax. A lot of people don't know that if you put 100,000 in to the stock market and it went to 80, you have a capital loss that you can use to offset any future gains, and you could carry that loss forward in time. Called a capital loss carry forward. So if you made a bad investment and lost 20,000 in 2022, and then you got a loss, you're like, oh man, what am I going to do? I can't write it off. The IRS doesn't let you write the whole thing off, but you keep it there. You write a little note. I will, you can write it on the chalkboard. I will never invest in this again. I will never invest in this again. Right. And it's just a bitter reminder, but it's nice because if you do have gains in the future, you can then say, oh, I just made 20,000 on that great pizza buffet deal that Tony came up with. The IRS is gonna be like, good job. You owe us taxes on that 20K. And you'd be like, but wait, what about that stupid bonehead move I made in 2022? I lost 20,000. On the IRS would be like, oh, okay, yeah. Zero taxes, right? Zero out. When you die, your carry loss dies with you. You cannot carry forward losses from your spouse in the future. That's a problem. So that year you lose a spouse, you want to make sure you're offsetting their capital losses because they're going to be gone if you don't. It's a big thing people don't realize. You can't carry loss forward when you're dead. Also, this is one a lot of people know about. When you sell your home, you get a $500,000 capital gain kind of exemption for a married couple. That when we did a show on, I'll put it up here for those watching. When you sell your house, if you bought it for $50,000 in 1980 and you sell it for $400,000 in 2022, 25, whatever, you have a $350,000 gain, say. If you're married, it's below the $500,000 exemption. You don't pay tax on that gain on the home, on your primary home. When you lose your spouse, you lose half of that exemption. So you can't write 500,000 off anymore. You can only write off 250 as a single person. Oh, well, that lasts for 2 years after death. So when you lose a spouse and you have a large gain in your home, you may want to consider how to utilize that exemption amount. Okay, something to consider. Okay, now you said strategies because we're bringing up terrible things. Let's talk about some strategies. Strategies to losing a spouse. An easy one is tax planning. First thing you should consider doing is hiring a CPA. That, especially, if you do your own taxes and then you lose a spouse, it's like, well, how do I, what if you remarry that year? What if, how do the brackets change? What do I?
It
All
gets
those
messy.
questions can be confusing. It gets messy.
Yeah.
And even if you do it yourselfer, you might say, maybe this year I'll pay someone just so I don't mess up. Because
you really need to.
This carry loss forward, what does that mean? The home exemption, like I don't understand.
And for your clients, they can come to you with these questions. You're not a CPA, but you can tell them, hey, here's what you need to ask your CPA. Here are some of the strategies. That's why working with a financial professional who knows you and your situation is so critical, Dan. I mean, I just really encourage our listeners, if they don't have a trusted financial services professional like you, who's holistic and looks at the big picture and all these different items, and stays on top of the rules, I mean, you're going to be out of luck.
Well, you're going to want to do tax planning, which is what I do. Tax prep is easy. You can hire someone to run the numbers, right? Plug it in the software. But you got to plan for this. You got to think this through. And it's like, well, should I file as married, jointly, or married separately? Am I a qualifying widow? What is that? You see that on there, a qualifying widow, head of household. What's the difference? But if you have lost a spouse and you still have dependent children, you could file as a qualifying widow. Well, tell me more about that. This is where you bring the CPA in and do the math, right? So tax planning is the number one way to mitigate these risks. Number two would be life insurance. Normally, life insurance isn't relevant for people that are retired. Life insurance is usually a income replacement. You'll see a lot of people say, oh, you need life insurance as a retirement plan to live off of your
cash value life insurance.
Yeah. That's usually for the super wealthy. For the average person, using life insurance for anything other than death benefit is a stretch. But you could use it as a death benefit so that if you do lose a spouse, you're going to lose their Social Security income. How are you going to replace it? What if you don't have an IRA? If you have life insurance, that's tax-free, and then you can use that and not have to worry about tax brackets because you're not paying tax on life insurance proceeds.
Or you can use the life insurance proceeds to pay the tax bill.
You could pay the tax bill on people that own farms like you, Tony, or you
Yeah.
can have the tax. You could just use that income to live over time and take less from the taxable account, so you stay below the threshold, so your Social Security isn't taxed. Because in our example, we said, well, she needs income, takes it from a taxable IRA account. All of a sudden now her income goes up, her taxes go up, and her Social Security is taxable. If you had some life insurance proceeds or non-taxable money, then you could pull from there and not raise your taxes. You could still go tax-free with the same level of income.
Right.
And life insurance is an easy way. Another way is a Roth. If you pull from a Roth IRA, you don't pay tax on it. There's no required minimum distributions on a Roth. So you could use a Roth in a case where this is a scenario where you still need the income, but you don't want to raise the taxes on your Social Security. Roth is good. So what do? You plan for that in advance and you convert money over time from traditional to a Roth. Ideally, when you're in your 30s, 40s, 50s, you're adding to a Roth instead of traditional. But for most people, they don't do that. They have just traditional IRA, 401k. You start converting, especially early in retirement when you're young, and maybe you have a little bit of leeway in your tax bracket as a married couple. Well, we don't spend 70,000. Why are we taking 70,000 out of our IRA? Because you're only paying 12% tax on it. I don't want to pay taxes. Well, no one does. But let's pay 12% tax now so that later you don't pay any tax, and if one of you dies, that'll help. And kids will love it too. So, conclusion, Tony. It stinks to lose a spouse. I'm lucky enough that I have not lost my spouse, but I've seen a lot of my clients have lost spouses. I lose clients to death every year, and I have a plan in place for how to handle it. And my clients go through the process, and they still get emotional, and they still make crazy decisions because it's difficult. On top of that, you throw the tax burdens in there. You throw this tax nonsense and tax tables and joint and single and carry loss, and all this stuff goes in their head, explode. So you need to get a CPA involved or a tax planner, somebody that's going to walk you through it. But ideally, you think about this while you're both alive and you plan for it. You talk about taxes, you talk about tax strategies, and you talk to your financial planner or your CPA and say, what can we do now while we're both alive and well to protect against some sort of tax burden if one of us dies? It's a weird question to think about, but why not? What else do you got to do? What else are you doing with your time? Right? There's a hobby. Plan your taxes out in case you lose a spouse.
Yeah. Well,
That's
good
it.
show. And really great information, Dan. I mean, a lot of people I don't think have any idea how this works. And again, the IRS makes it complicated, makes it difficult for people, and has stupid rules that, penalizes, the surviving spouse, these tax rules. It's infuriating, but it's good to know that there are strategies that if you put them in place beforehand, will help you deal with that. That's really the message here, I think. And Dan, I encourage our listeners and viewers on YouTube to give you a call to get a plan in place. It's just so important.
Yeah. And most people in this country, retirees, are using Social Security as their foundation.
Yeah.
It's a big part of it. And they really, really need to understand how the taxes are impacted when they lose a spouse.
Yes.
It's a traumatic experience, but it happens. So, yep. Hopefully you learned a few things. Give us a call if you need anything. The number is 888-508-5935. Again, we're not tax preparers. We don't give tax advice, but we're here to give tax planning advice. Just give us a call. Tony, thanks for a good show. We'll catch everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management Inc. and Dolphin Insurance Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.